You are a new trader in the forex market and you are struggling to find out where the market is going. You try to sell the market when the market is in an uptrend, and you try to buy the market when the market is in a downtrend. And because of this, you end up consistently losing money. Sounds like you? Here's the solution. This video, I'll be covering all you need to know about market structure, one of the most important concepts in forex trading, regardless of whichever strategy that you are trading. So get ready to unlearn and then relearn whatever you know about market structure and try to feed your brain with things that will make you profitable. Let's get right into the video.
Welcome to video 5. In this video, I'll be explaining the overarching concept behind market structure and how to identify fractal points, or simply put, points of reversal. Now, here are 3 main issues I'll be addressing with regards to market structure. Firstly, how to draw uptrends and downtrends. Most people think that they are sufficient in identifying the different trends, but in actuality, if they really did, they'll probably be funded with multiple profits, like me. Now, not to worry, I'll be explaining how to do it and the criteria needed to qualify a strong uptrend and downtrend. Lastly, I'll go through how to spot potential trend reversals. This is going to be so important as it helps you to risk manage when you're in profits as well as look for potential counter trend trades. So pay attention to the next few minutes and take notes in your notebook or iPad, whatever it is, I don't really care. So you can always refer back to it in the future. So let's get to it. Now, what is an uptrend or a downtrend? Simply put, we are looking for higher highs and higher lows. Each time the previous high breaks, we form a new higher low. This is how an uptrend usually looks, not like those kinds of things you see online with very nicely drawn uptrend channels or downtrend channels. Okay, so pay attention. Similarly, for a downtrend, we're looking for lower lows and lower highs. Each time the previous low breaks, we form a new lower high. Now, let's take a look at a bullish example for reference, as you can see here on the slide. Here, we have identified a market where the price has started to create a higher high, as seen in the image. And once that happens, we can identify the new low that's formed. How do we do that? Well, we look for the lowest point where the price went before breaking the high. And as you can see here, it keeps repeating the same process again and again and again, and therefore we are in an uptrend. What's the criteria for a strong versus weak high or low? For a strong uptrend, it's pretty straightforward. We're looking for a body candle closure above on the higher time frame. This means anything above the 1 hour chart. So this could mean the 1 hour, 4 hour, daily, and so on. Why is this so? With a body candle close above, it indicates strong buying pressure from the markets, making it a high probability for price to just continue higher. So in this video, you can see price broke through the previous high with a body candle close. Even if it's just by a little bit, price came down, failed to break the newly formed high low, then proceeded to break the newly formed high. Therefore, this is counted as a very strong uptrend. Now, similarly, for a strong downtrend, we need to see a body candle close below the previous low in order for it to qualify as a strong downtrend. In this video, we can spot a strong bearish body close below the low after trying to break the high and fail, resulting in continued bearish prices that ensued after the close. Now, here is the caveat. For a weak uptrend, it's qualified by a wick candle close above the previous high. I said wick, not weak. The reason for this is simply when price breaks above the previous high and closes as a wick below the previous high, it shows bears are potentially stepping in, fighting the bullish pressure, resulting in a weak uptrend. In this video, we can see that the price tried its best to break and close above, but it failed. And what happened after was price proceeded to take out the high low, completely reversing the direction of the markets. This is why it's riskier to take trades in a weak uptrend versus a strong uptrend. Now, lastly, likely in a weak downtrend, it's qualified by a wick candle closure below the previous low. In this video example, you can see very clearly the candle closed with a wick instead of a body close. This resulted in price humping all the way up to break the high, making it very risky to trade in a weak downtrend.
What up, what up? If you're enjoying the course, then I guarantee you enjoyed the hundreds more hours of our social media content. We post weekly on YouTube and daily on both our TikToks with thousands of videos on Forex education. Drop us a follow and like there. Anyway, back to the video.
Now, with a clear understanding of uptrends and downtrends, you must be wondering, why is it a downtrend but the price looks like it's going against the trend? Am I wrong? Well, let me answer with a simple question. Have you ever seen a chart where the price just moves in one single direction forever? Obviously not. Let's hop onto the charts to show you an example of basically what I mean.
Here we have a 4-hour chart, gold, and as you can see, price has dumped massively, but you can suddenly see a price start to pop up. Now, you must be nervous if you are in a short position because you will be in drawdown and you're expecting price to continue melting. But let's see what happens after this so-called pop. As you can see, price continues to melt. Now, why is this the case?
This is what we call a retracement. A retracement happens when price is heading in a specific direction but pulls back before continuing in that direction. So in a downtrend, price will go down and then pull back up for a short little bit before heading down again, continuing the downtrend. Now, this is important. The reasons why you are panicking when you are caught in retracements is very simple. Okay, number one, you're too focused on the lower time frames. What are some examples of lower time frames? Well, 1 minute, 5 minutes, or even sometimes the 15-minute charts. These time frames tend to trick you into having the direction wrong. Why? What you're looking at is called a micro trend. You don't want to be looking at micro trends. You want to be looking at the macro trends. Now, these macro trends usually form on higher time frames like the 1 hour, 4 hour daily, weekly, monthly charts, whatever. Macro trends have a higher advantage over micro trends because the banks and institutions, which are the big money, use higher time frames to place their huge orders. So, in summary, now you know how to identify what a proper high probability uptrend or downtrend is. You know what you shouldn't be stuck on a lower time frame too often, and you need to zoom out to get a clearer picture of the market direction before placing a trade.
Let's be real. If all it took was a few videos to get rich from trading, you and everyone else would be rich from YouTube traders. But of course, you and I both know videos ain't enough. So, if you'd like to accelerate your progress and get results like the thousands of screenshots I have here, then just drop me a message at Callisto Admin Main. It's free to join. Hope to have you in the family.